theme of the day just ties totally to the tagline that we have associated with KX, survival of the fastest. And when we came up with that, it was really on the basis that, yes, speed is important, but what kind of speed and what context is that speed important in? And I think what we've been listening to today are the many dimensions of the problem that's associated with the same fundamental issue, which is speed in this context is about adaptability, the ability to respond and react faster than your competitors to a change in market conditions. And that's really the theme that I want to talk about. It would be remiss of me if we didn't spend some time today talking about perhaps one of the biggest impacts that we've seen in the course of 2025. And probably it's now a permanent fixture of the environment in which we're operating, which is essentially unprecedented levels of volatility. And it's made itself impossible to ignore. If we go back to the spring and we think about the impact of the first wave of tariff headlines, we saw equities and bonds moving together in ways that we traditionally had not seen. We saw options trading rising to record levels. We saw gold keep rising as investors were searching for safety. And these were not one-off shocks. We could argue that these are really bursts of stress that have tested every firm's processes. And the new rhythm of modern markets is essentially calm periods, it seems, followed by sharp bursts. And it's not that they happen, it's that they keep happening, and they keep happening in new ways. And the way that we interpret that and think about that in the context of the businesses that you are in is really that this is not the problem inherently in itself, because actually volatility creates tremendous opportunity. But it is the proving ground to test and stress test your processes, systems, and infrastructure, and the way that you're able to leverage that to your advantage. So for us, it's about readiness. It's about anticipating these events, building the right environment, and operating within that. And what we thought we'd do in this last session is to talk about the real challenge that this represents. As our world becomes noisier, signals are still there to be found, but the problem is that they are more fleeting, more fragmented, and harder to capture at speed than they've ever been. Which means that if your systems cannot ingest data, contextualize that data, and respond in real time, then you have a significant disadvantage in your marketplace, and that will cost you dearly. So I think we can all probably accept as a basic fact that idea shelf life is shrinking. Reaction time has become the key currency of performance. And what you're seeing on the screen here is a statistic taken from the KX 2025 Capital Markets Data Report. Now, this has not yet been published. We'll be publishing this in the next few weeks. But this is based on research, primary research that we did with over 1,000 quants and 1,000 IT and data leaders around the world in capital markets. So I'm going to use and share with you some of the information from those reports in my presentation this afternoon. But this one is pretty significant. Latency, a delay in their ability to respond and react to changing conditions led to almost half of our respondents saying that they had missed trades. It wasn't because they couldn't see the opportunity, it was because they couldn't translate that insight into results fast enough. So I want to talk about 4 things that have changed and 3 things that have not. I believe, firstly, that our market tempo has changed. What used to happen over a period of days is now happening in a matter of minutes. Secondly, trading behavior. Think about it. Same-day options used to be a niche in the market, and it's now the majority of the S&P 500 options trading activity. Thirdly, cross-asset connections. I mentioned just a moment ago equities and bonds moving together, but the reality is that shocks are no longer contained in a single asset class. They are now interconnected. Markets, risk, models, all operating in ways that we haven't seen historically. And then fourthly, elevation of throughput. Our volumes are growing dramatically, and they're not reducing anytime soon. In fact, I don't think we should anticipate a reduction in volumes. I think we should anticipate a continuation of volatility. It is the new normal. Now, that being said, not everything is changing. Arguably, three things have not changed and won't change anytime soon. The first is the mission itself. What are we in business to do? We're in business to price risk accurately. We're in business to find opportunity and to protect capital. Those three things remain core. The second thing that hasn't changed is the value of preparation, because volatility rewards preparation. Being unprepared is to lose in the marketplace. So resilient infrastructure and fast recalibration are the two themes that we're going to be holding on to as we think about what separates winners from losers. And I'm going to share a few stories in my talk this afternoon around some of the ways that KX customers have been able to win in this new volatile environment. And finally, the third thing that's not changed is the principles that work, which we could characterize as fresh, fast data, unified context across asset classes, and systems that can handle overloads gracefully. Because much as we can prepare for the future that we don't yet know, the reality is things are going to happen that are outside of the bounds of what we anticipated. What do we do under those circumstances is going to be critical. So let's start by talking about a customer that actually tackled some of these challenges proactively. So Lab Quant Strategies told us before they got to be working with us that they had a problem with ideas, not the lack of the ideas, but that the time from research to production was just taking too long. In fact, they characterized it as taking days, which is pretty scary. One of the problems they had was fragmented data pipelines, which meant that they couldn't handle real-time markets. And that, as we know, is becoming an increasing feature of the environment in which we're operating in. As a result, they implemented our Insights Enterprise product on their AWS platform, which has dramatically reduced the time taken for them to get ideas from research to production. They now think in terms of hours, not in terms of days. They've unified real-time and historical analysis. They've integrated their Bloomberg data feeds, and they are now performing live computation on key metrics like VWAP and volatility, on top of which they also shared with us that they'd saved about $300,000 on custom infrastructure that they had been previously working with. So streamlining, simplification, and improving responsiveness were key to their success based on their implementation. As we think about this particular topic of volatility, I think it's important for us to go back to some of the basics. And I love this quote from Kat Turley. Many of you will know her. Just set up an office in London. Congratulations to her for that. Working with many of our clients on this issue of ensuring that the data environment is appropriate to the decision-making on which our business success depends. And it is a true statement, is it not? That data itself is not commoditized. Data itself is actually becoming more expensive. As we are required to ingest more and different types of data, cost is going up and not down. So the way in which we use that data and transform it into value for our businesses is going to be increasingly important moving forwards. Yes, a lot has changed. Markets are faster. Trading is different from the way that it used to be, and cross-asset linkages are increasingly important to us, but the fundamentals haven't. And what I want to do in the rest of our time together is to talk about what separates winners from losers, because it's not really just about the models or the data or the infrastructure in isolation. It's really about how all three come together under pressure. So I'm going to talk about three shifts based on our research, working with our clients and 2,000 respondents to our survey. The first is going to be about timing, which is around this issue of shortening idea shelf life. How do we take advantage of that to ensure that we're not too slow for the markets? Second of all, I want to talk about situational awareness, which is really around context, because volatility hides signals in a fragmented data, which means that you need a unified view if you are going to see what others aren't and be able to act on it. And the third is a concept that we call durable speed, because speed is important, but speed is not more important than resilience. If we're not able to operate in a resilient fashion, speed will lead to brittleness, and brittleness will lead to problems. So taken together, these three shifts are really about a framework for resilience. and showing what it takes to stay operationally strong under stress and converting volatility into opportunity is really where we're going next. So I want to talk about some of the statistics that support our first shift, which is this idea of reducing time to deployment from models to market. Because turning an idea into action is really a multi-step process, as we know. It starts with research to derive signal from the noise. That signal then drives strategy, and strategy then drives trading. And here's our first step. 84% of quants say that speed to insight is their edge, yet most still wait days to move from idea to action. So this is not a small problem, and it's not limited to a few. This is a widespread issue. The second insight from the data here, for me, is that it's not actually about the most elegant model that wins. It's about the first to deploy. 44% of analysts said that they'd missed trades due to execution delays, which is the stat we saw earlier, and 35% said that they couldn't model risk scenarios fast or accurately enough for it to be able to impact their trading activity. That's pretty scary. You know, we can look around markets outside of capital markets and realize that it's not always the best product that wins. It's the product that catches the market first that typically takes the winner's prize. And then the third key insight here is around this issue of organizational friction. And the reality is a combination of organizational factors and legacy infrastructure arguably are two of the biggest barriers to be overcome, with, look, more than 2/3 saying that adopting new technology is harder than it needs to be because the organization is not set up in a way to facilitate that. And that's obviously close to all of our hearts in this room. I want to tell you a little story about Treehouse Labs. Now, Treehouse Labs are focused on serving crypto traders who live in a world of volatility, as you will appreciate. They have a mandate to deliver real-time insights and portfolio strategies across what is a very fragmented digital asset market. They have literally no tolerance for latency. They chose KDB, specifically Insights SDK, for their core Hyperion platform. That platform ingests and creates as-of joins across more than 100 different crypto feeds from centralized exchanges, DeFi protocols, on-chain data. They're now able to update their strategies in less than a second. That's been significant for them. They had the typical experience before KX that many of us would recognize, which is their quants would identify signals, they would run backtesting overnight, their feature engineering code was developed by another team, and the model was then rewritten by yet another team for their production environment. That's just a ton of opportunities for latency, for misalignment, or just loss of momentum. After KX, they now have a unified environment to allow for signal discovery and testing, for feature extraction from both structured and unstructured data, and for live deployment with access to time-aligned, real-time, and historical data, all in one platform. They can now move from their model to the market in hours, not in days. It was transformative for them. So time from model to market matters. That's our first key shift. The second one I want to talk about is situational awareness. Now, DeepSeek has been mentioned a couple of times today, probably for a variety of different reasons. But what I want to bring out from this story is that information shocks are just as critical as price moves when it comes to volatility. What's really interesting about this story is that the market narrative was moving faster than the models. And the market took time to catch up, and when it did, it had a huge impact. Think about this. Despite the fact that there was a lot of data, a lot of signal coming from DeepSeek themselves, they were very transparent about what they were doing, what their models were going to enable, how they were going to transform the market. And the market itself did not respond in real time, far from it. Look at these dates: May 2024, July 2024, December 2024. The markets were essentially unmoved by this evolution of tremendous capability. And when it eventually came, I think we could describe it as panic. Billions of dollars were wiped off equity values in January of 2025. The issue here was not that the signal was not available, it was hidden. In a sense, it was buried. Maybe it was fragmented, but it was easy to overlook. And we could argue that that was because there wasn't a unified view of the data to inform that signal. Integrating different data sources is going to be key for our success moving forwards. I think we all appreciate that there is opportunity for us to learn more as we bring more data into our environment. The challenge of it is typically that that's associated with an increased level of noise. It becomes harder and harder to make sense of it all. This quote from James Corcoran, who is now head of AI at Stack, I think summarizes really the situation here. It seems completely necessary to combine structured and unstructured data for good outcomes in AI. If you infuse structured time series data into unstructured text outputs, you get responses grounded in real, decision-ready insight. That's what instills confidence and improves situational awareness. You know, a year ago at our summit, this time last year, we were talking about the impact of generative AI in capital markets. And a great deal of concern was expressed by many around the risk associated with bringing data that was not grounded in structured data into the capital markets environments. And I think a very legitimate reason for concern. What we've been hearing about today is thinking a little bit differently. Rather than thinking about bringing the generative AI into the structured data environment, it's really about how we extend the structured data environment to embrace the signals that can be generated from that broader data set. It's the starting point, not the end point. And that is what is going to bring confidence. And yet, here's some interesting statistics from that capital markets data report that I mentioned. Only 18% of firms today say that they can effectively combine structured and unstructured data. Yet, unstructured data is today 75% of their enterprise information. So it's a huge untapped opportunity that we should be leveraging. And add to that the statistic that 54% of leaders cited data silos as the top barrier to innovation. It's pretty compelling. It's pretty obvious. So let me tell you a little bit about B2C2, who I think most of you will be well aware are a key London-based market maker in digital assets, focused solely at institutional clients. They are operating one of the only truly 24/7 markets. As Jed Sarno, who's the head of quant development for B2C2, told us, crypto never sleeps. There are no weekends, no off hours. Our systems have to be always on, or we are blind. They are ingesting, as we heard earlier, terabytes of fragmented data every day from over 100 exchanges and blockchains, each with its own quirks. And without a unified data fabric, they simply couldn't see or act on risk fast enough. This is what Jed had to say about that. Getting clean, real-time, high-frequency data in crypto is a serious engineering challenge. There's no co-location. Every venue has different infrastructure and data standards, and feeds come in every format. On-chain, off-chain, derivative, sentiment. Normalizing that in real time is tough. No kidding. But B2C2 identified that KX could help them with that and brought it all together. They now combine market data, blockchain data, and client activity into one single real-time intelligence layer. That gives them sub-second analytics at scale, elastic processing of tens of terabytes of data every single day, and instant visibility from trading to compliance. They can now see risk, liquidity, and opportunity as they happen, act instantly, and stay resilient through even the most volatile market events. And that is borne out in the results that they have been posting. And that's what situational awareness looks like in a 24/7 market. That's going to be impactful for all of us. Here's Jed again. We've had major market events, crashes, even exchanges disappearing overnight. The infrastructure, I love this, was boringly smooth. And boring is good. when you're talking about real-time trading systems. I think we can probably all relate to that. So, boring our jobs are not, but if we can make it boring for our businesses, we're doing the right things. Am I wrong? Let me talk about our third shift, durable speed. What do we mean when we say durable speed? We mean the strategic capability to reduce the time from signal to decision to action without compromising resilience, transparency, or control, especially during periods of market disruption. Look, everybody wants to move faster. Everybody wants to move faster, but not everybody is building for the repeatability, the explainability, and the auditability that is implied and required by that. And here's why. Because speed or performance without resilience does have consequences. It creates fragility and only temporary advantage. How do we know that? Because look at the data. 40% of our analysts said that their models underperformed in live markets versus backtesting. What does that mean? It means we have overfit models. We have unexplainable AI. 37% said that AI failed during market shifts or rare events. And we have brittle infrastructure. Those are significant problems. The mandate today has shifted. It's no longer good enough to just come up with black box predictions, as we know. We need transparent signal pipelines. Outputs are no good without evidence. And individual model wins fall short when compared to firm-wide trust in infrastructure. Trust is earned. And it's earned through governance, it's earned through lineage, it's earned through auditability. So we need to be building for those environments if we want to sustain that speed advantage. Because there's no doubt we can gain advantage in the short term but lose it in the long term if we don't think it through. MFS is a great example of that very thing. They needed to modernize their execution analytics infrastructure. They had tools that they told us were slow, fragmented, and didn't offer the insight they needed to improve their performance across their desks. They deployed KX, and they were able to deploy real-time post-trade analytics and FSI accelerators, which gave them deeper visibility into their trading behavior, helped them to optimize execution, and enabled them to scale with confidence. Durable speed is not just about being faster, it's about being safer. So I've mentioned 3 shifts so far. I'm going to give you one bonus shift, which is associated with this problem that we saw earlier around friction, organizational friction. The reality is that volatility is not just a technology problem to solve. In fact, arguably, it's more an organizational problem to solve. It stress tests organizations themselves. An observation that we could make is that when markets are calm, and I did say earlier, the volatility typically is periods of calm followed by short bursts of activity. When markets are calm, it could be argued that the front office, the middle office, and the back office can each focus on the things that are particular priorities for them, whether it's speed or control or governance. But when the pressure is on, in times of volatility, a siloed approach translates into fragility. And there is friction and tension today, as we can see here, between the front office and the back office. 68% of technology leaders feel overwhelmed by the demands of analysts. 83% by converse of quants tell us that they don't feel listened to by those same technology leaders. In fact, 41% of quants say that they feel they are being blocked from access to new technology. And we spent a lot of today talking about technology, new technology, and the opportunity that that represents. That's pretty concerning. I wonder if that's how it feels to you sitting in the audience today. That's concerning. On the plus side, the same survey told us that 83% of technology leaders now say that they are actively involving quants in technology decisions. We just heard Chris say one of the keys to success is bringing both sides of the business together to think holistically. Camille was making the same point. So there is evidence of improvement in that area. I would argue there's still some ways to go. But why should we make that a priority? Because it delivers results. In fact, this was quite a striking statistic to me. A 6.5-month advantage for those firms that were able to align quants and IT compared to those that were not. Alignment is essential in volatile markets. It's not a nice to have, but those that do get it right under pressure translate that into performance. So we've talked about 4 shifts that are happening now and that we have the opportunity to leverage to be a winner in the era of not just AI, but also volatility. We could argue that this is a leapfrog moment in capital markets. And let's be honest, we can be easily swayed by the attractions of new technology and lose sight of the fundamentals. I would argue that dealing with volatile markets is a fundamental issue that we have to address in our businesses, and technology is part of the way that we can solve for that. Leaders, we have observed, are redesigning their data and their decision stack, specifically to address the needs of this era of volatility. It may require a more fundamental rethink than you were expecting when you came into this meeting today. But I hope that we've given you some inspiration as to the things to be thinking about and how you can be successful to overcome these new challenges that we're facing. Our KX customers are invariably setting the pace. They're building systems to thrive in volatility. That means systems that collapse time from signal to strategy. We started the day talking about the signal generation engine that is KDBX. That's our vision for our platform. It's how we think about it. It's not a database. It's not even an analytical database. It's a mechanism to generate signal from an increasingly fragmented and complex data environment, and then translate that seamlessly into executable strategies. It's about bringing the complete data set together, structured and unstructured data. Are you designed to do that today? And if not, what can we do to help you get there quickly? And then thirdly, this critical issue of durable speed means safe experimentation, trusted deployment, and the ability to operate in real time with support from the business. We have talked about quite a few customers today. SMBC, a customer we haven't talked about, told us that they had generated $31 million from their EFX business as a result of implementing KX in an environment where that was not their legacy, that was not their history. That was a very significant achievement for them. I have told you about Treehouse Labs generating strategy updates in less than a second. These are companies that are thinking smarter, they're adapting faster, and they're scaling innovation. And I'm so glad that so many of you are in the room today to testify to that. But for those that are net new, I'm going to pose a few questions that you might like to ask of your team when you head back into the office. If you're here as a quant leader in the room today, here's a few questions that you might like to think about. What is the cost of latency in your business today? How would you go about quantifying that? You're a quant. How about quantifying that? Because that is something that you should be thinking about. Because if it's time to make a change, it needs to be predicated on the advantage that you're going to gain as a result. We talked about decision gaps. How do you think about yours? Is the issue for you the data or the infrastructure, or is it the combination of the two? How long does it take you to get from research to deployment? Have you measured it? What would you want it to be, and how is it today? What if you could simply cut it in half? What would that mean to you? Good questions to get good answers to. By converse, for the technology leaders in the room, can your governance and risk teams trace every production decision in real time today? Do they need to? Will they need to? The counter question for the quants. What do you know about how long it takes for ideas to translate from concept, from signal to strategy to execution? Are you spending more effort on platforms and pipelines than on the models themselves? Where's the real opportunity to win in your business? And how much alpha are you losing because your systems can't keep up? There is a cost to every decision that we make in our businesses. understanding the size of that cost helps us make better decisions. And that's what we're all about. Our contention is that every company in this room has the data it needs to win in your marketplace. The question is not about whether you have the data, it's whether you have the infrastructure to make sense of the data and to use it when it matters. If volatility is the new normal, then speed, trust, and real-time intelligence is the new advantage. I believe that there is a new edge, and it can be attained, but only if you're willing to build for it. I say, let's do it. Thank you so much. And I'll go on to say, and let's do it together, because it's a lot more fun. And if the fun is going to stop too soon for you today, I'm going to invite you to an event that's happening tomorrow. Tomorrow night is our London meetup. This is where we focus on our builders, and we're bringing them all together in this wonderful venue at Hi Jingo Bingo, which sounds like a lot of fun to me. So if you think that might be something your team should be attending, then I encourage you to make them aware that invitation is open to them, and they will hear some fantastic stuff. They will see some fantastic stuff. Some of the demos that we couldn't squeeze in today are designed for that audience, so I encourage you to bring your teams to that. And then before we wrap it up today, I would just ask you to take a quick shot of this screen so that you can give us your feedback. This is our survey based on today's event. If you'd like us to continue with these kinds of events, please give us your feedback so that we can shape the next event to better meet your needs. So with that, I want to thank you so much for taking the time to be with us today. I hope you got some real value, and we're now going to move to our cocktail reception. So I encourage you to keep the conversation going. If you didn't agree with something that I or any of the other speakers said, this is your time to go and make your points heard, and we look forward to your feedback. Thank you again, and we look forward to a wonderful year ahead with you all. Thank you. Have a great evening.